Thank you very much for joining me in this video. I want to talk to you today about mortgages and specifically mortgage renewals. As you know, there's two kind of key components to a mortgage we want to keep in mind. One is the amortization period and one is the term. The amortization, amort, means how long it takes you to kill the mortgage, how long it takes to pay it off. And generally it's quite long. In fact, it's usually 25 years, maybe even 30 years. And in some cases we've seen it as long as 40 years. It takes a long time to pay that mortgage off. The term, on the other hand, is how long the lender commits to that specific loan or mortgage. How long he commits to the rate, how long he commits to the payment schedule, and so on. And because the amortization period is so long, although if you know me, you know I try and encourage you to get that amortization period down, shorten it. I like to aim for 15-year amortization, but even at 15-year, your term is going to come due before your mortgage is paid off. And what that means is you're going to be looking at an opportunity to renew your mortgage. And I use the term opportunity because it is generally an opportunity. It gives you a great opportunity to renegotiate your mortgage. Most major lenders are looking for new business, and they try and entice customers to come and do business with them. And they may offer them 2 or 3 months free. They may offer them a cashback. They may offer them lower than going rates for the mortgage. And they don't always offer the same thing to their existing clients. Well, if they think you're going to go to a competitor, they'll sharpen their pencil and they'll offer you those things. And so the threat of shopping around will help keep you in best standing with your lender as far as the renewal term. Now, you may actually want to shop around and see if there's a better lender out there who will provide you with better terms on whatever you're looking for in your mortgage. But I want to caution you here. Although it's a great opportunity to renegotiate your mortgage, and you may want to do it to take some equity out. You may want to take some money out of your mortgage by increasing the amount of your mortgage because you want to take that trip you've talked about for years, or you want to renovate the house, or your kids are going to university. Any number of reasons why you want some money out. But here's the thing. If you bought that house 2020, 2021, or 2022, the chances are it isn't worth as much as you paid for it. And what that means is that your equity has been reduced. Now, if you paid $800,000 for the house, or your client has, and it's only worth $700,000 today, you are going to have a problem when you go to a competing lender or somebody else to shop your mortgage. See, they're going to want to do an appraisal, and it's not going to appraise for what you need to replace your existing mortgage. Even if you go to your lender that you have your mortgage with and you talk about opening your mortgage to try and increase it, they're going to appraise it. All of a sudden, they see it's not worth what they thought it was, what it was when you put the mortgage in place. There's a red flag in your file. And there's nothing in law in Canada that forces them to renew your mortgage. You may have a problem with your lender because they've just done an appraisal. So if you recognize your situation so that you know your house is worth less than you paid for it, your equity has shrunk, just sign the renewal paper and get on with your life. That's the best thing you can do. But I want to also talk to you about secondary financing. There was a time years and years ago when we were putting property deals together where we would often encourage the seller to hold secondary financing. We called it a VTB, or vendor take back. What would happen, and back then the conventional mortgage went up to 75%, not 80% like today, and we would ask the vendor if he would hold secondary financing of 15%, and it would allow the buyer to go in with 10% down without paying high fees for an insured mortgage. And sellers often were prepared to do that. They got the bulk of their money out. They were glad to hold a 15% mortgage, and the deal went together. But when you're, and of course there's other reasons why people may have put in secondary financing. But when the meltdown occurred in the US, the Canadian banks tightened up, and most of them don't allow vendor takebacks at the time of the purchase. In fact, they have the buyer sign a declaration and there's no subsequent encumbrances. I don't know why, because their position is secure. They're in first place. They don't have to worry with a subsequent. It doesn't affect their security. But for whatever reason, they don't allow it. But after the fact, you may have gone and put a second mortgage on it. It might be a registered credit line against the property. It can be a private lender that you've taken some equity from your property in the way of a second mortgage for all these things you want to do. Whenever we're talking about secondary financing, there's two things you have to keep in mind. The first is a postponement clause. Have to have a postponement clause in that second mortgage. Why? Well, a first mortgage is first, not because it's larger, not because it's with one of the 5 institutions rather than private funding. It's a first mortgage because it was registered first. And it's important to them that they stay first mortgage. If you have a second mortgage you put on later, and now your first mortgage comes up for renewal, in order for them to renew it, they've got to lift it, they've got to replace it with the new terms and conditions of the mortgage. Well, because you've got a second mortgage already in place, it's going to slot into first place, and your first mortgage, when it gets renewed, is going to be second. Well, your lender isn't going to stand for that. They're not going to allow themselves to be in second place suddenly, and you've got a problem. Bear in mind, there's nothing that forces them to renew your mortgage. They can insist that you pay it out somehow, or that you pay out the second mortgage so it's not going to be renewed so that the first mortgage stays in first place. The other way is with this postponement clause. What that means is that when the first mortgage comes up for renewal, they temporarily lift the second mortgage, they re-register the first mortgage, and then they drop the second mortgage back in second place. Everything's fine, but you need to have that postponement clause in there. The second thing you got to look at, and I've always cautioned people about this is the term for the second mortgage. Especially in the case of a vendor take-back. That vendor put that mortgage in place not because he wanted to invest 15% in his property, but because he wanted to expedite the sale. And so he may have put it on there for a year or 2 years. He's not necessarily committed to the full ride until your first mortgage gets paid off. And so when the second mortgage comes due, it may not automatically be renewed. There's no requirement for him to do that. I had an agent call me a week or so ago, and they said, Wayne, I've got a question for you. I got a little situation. I got a property listed for sale. It's got a first mortgage and a second mortgage, and the second mortgage is coming due. The chances are that second mortgage is not going to, the property's not going to be sold and closed before the second mortgage becomes due. What happens there? Well, the owner's got a problem. See, that second mortgage has every right to be paid out when it hits due. If they're not prepared to renew it, then the owner's got an obligation to either have it absorbed in the first mortgage by refinancing, or that may be closed out depending on the equity in the property, or finding funding somewhere to replace it, or coming up with the money to pay it out. If he doesn't, he's in breach. He's in as much breach as if he was having his first mortgage and he started to miss payments. And the lender, if it's missing payments, can force the sale. So can the second mortgage because it's due and you don't have a way of paying it out. So if you're involved with a client and they're looking at secondary financing, maybe you've got a lender that will permit vendor take-back or something for the second mortgage, bear in mind it's got to have a postponement clause, and bear in mind you've got to anticipate it coming due and make sure there's a provision to have it renewed or replaced or paid out. Hope that makes sense. Thank you for investing your time. I'll talk to you again next week.